It's time to begin tonight. Tonight we're talking retirement planning. After tonight's discussion on retirement planning, we'll have a discussion next week regarding current issues in ministerial taxation, as well as an internal control discussion. Internal control discussion being one of those items that is not totally just applicable to a minister, but just discusses various situations you may run into during your ministry that you or an eldership or treasurer or somebody needs to be aware of. So after that, the 3rd or the 8th of March, we'll have our final review and final exam, and your paper will be due at that point in time. So to tonight's discussion, retirement planning. There are two options for retirement plans allowed by the Internal Revenue Code: a church plan or an ERISA plan. ERISA stands for the Employee Retirement Income Security Act, which was passed in 1974. If you are subject to ERISA, or if your retirement plan is subject to ERISA, there are a lot of other things you have to do as far as participants and filings, etc., for that plan, as well as other costs that may be involved. So let's first discuss, if I can get back here. Church plans are defined by ERISA as being established and maintained by a church or convention or association of churches for its employee or the beneficiaries of its employees. The statutory definition under ERISA also includes entities who are tax exempt under Section 501, such as churches are, and controlled by a church or convention or association of churches. So, for example, a mission board or a church or school or something else that might be controlled by a church would also be allowed to have church plans established for their employees. A church plan is a plan that is established under state law, not under the federal law, Section 401, which defines various types of retirement arrangements, but they would be established under state law. They're exempt from ERISA as a provision of the ERISA Act. The ERISA Act actually carves out the exemption that we talked about earlier. Those plans that are established by a church or a group of churches or a denomination and are established under state law. The church plan itself can elect to be subject to ERISA. Under Section 410D, the ERISA, as it carves out the exception, gives the church plan the right to void that exception and be subject to ERISA. So if a church plan did so, it would be subject to all ERISA provisions. So what are those ERISA provisions? ERISA provisions include reporting requirements. You have to, depending on the value of the assets in the plan, potentially report every year a Form 5500. You have to have certain disclosure requirements. The parties who are responsible for the plan have certain fiduciary responsibilities. There are various non-discrimination rules that exist under ERISA. If a church plan subjected itself to ERISA, then it would have to pay for coverage under the PBGC, Pension Benefit Guaranty Corporation. There are certain minimum participation requirements, certain minimum coverage requirements, and minimum vesting requirements, such as you have to cover everyone who is at least age 21. You can't go over 2 years before you're fully vested or start vesting. You can't exclude certain categories of employees. You have to include all employees. just a variety of things that if you elected to be subject to ERISA, or if you set up a plan that was subject to ERISA, and we'll talk about some of those plans later on, then those minimum vesting and participation and coverage requirements have to be met. There are a multitude of cases and private letter rulings that allow a retired minister to have a portion of their retirement income designated as a housing allowance. We talked about this idea in the housing allowance discussion. We talked about this idea in the income discussion. The benefit to this is that the retired minister who gets a housing allowance designation for some of his retirement income does not have to pay income tax on that. And because he is retired, then he is exempt from Social Security tax or self-employment tax on that income as well. So in essence, it becomes tax-free income, whereas the active working minister who gets a housing allowance and is not exempt from Social Security Medicare tax has to add that back to calculate his self-employment income, and is subject to the housing allowance dollars are subject to self-employment tax. So that would be the distinction here. The IRS in 1989 issued Revenue Procedure 8954, and every year since then has also stated that this is an area that is under study and that the IRS will not issue rulings or determination letters until it resolves the issue. So as you can see, this issue has been going on for close to 30 years now, where the IRS is not issuing any determination letters or making any rulings on this particular area about whether or not retirement income can be designated as a housing allowance. I did a little bit of search earlier today and did not find the 2018 designation, but if they have not issued it yet, which I would be surprised if they haven't yet, but I will not be surprised if they make a similar statement for 2018. There are a number of items that they include in that revenue procedure that they're just not doing anything about currently, or they say they will plan to do it. They have it under study, but are not issuing rulings or determination letters on those items. In Revenue Ruling 75-22, they allowed a denominational pension board as a part of the retired minister's pension plan to designate a portion of that monthly pension amount as housing allowance. Since the IRS will no longer issue rulings on that matter, that's the latest guidance we have on the availability of designating a portion of the retirement payment as a housing allowance. However, the Clergy Housing Allowance Clarification Act of 2002 implemented the restriction, as you will recall during our discussion on the housing allowance, that the non-taxable amount of a housing allowance cannot exceed the fair rental value of the home, including furnishings and utilities. Remember those three numbers that we need to compare to figure out which one we get to deduct, what amount we get to deduct for housing allowance. The amount of the allowance that was designated and agreed to in writing, preferably in writing by the church, or the amount you actually spent, or the fair rental value of the home, including furnishings and utilities. So the fair rental value of the furnished home plus the utility amount. So those amounts get compared, and whichever one is less is the one you get to take as housing allowance. All right. If your church does not establish a church plan as a retirement plan for you, you could establish for yourself, or the church could establish for you, an ERISA plan. ERISA meaning that Employee Retirement Income Security Act. So if you needed one of those plans, or if someone established one of those plans for you, those plans can either be defined contribution plans or defined benefit plans. Let's talk about what those two differences are. A defined contribution plan, which most employees in America that have a 401k, they're dealing with a defined contribution plan. The company defines how much they will contribute to the plan on behalf of the employee. It may be stated as a match depending on how much the employee contributes. It may be stated as a set dollar amount. It may be stated as a percentage of salary. There are a variety of ways they can define that. But a defined contribution plan, they define how much they will contribute to the plan on behalf of the employee. By distinction, a defined benefit plan, the company defines or calculates how much to contribute based on the benefit that the employee is to receive once retirement occurs. Many years ago, that was the general way that pension plans worked. They were defined benefit plans. IBM said, if you work for us for 30 years, we'll pay you a pension of X per year once you retire. A lot of the auto manufacturers and various and sundry other entities, large companies, had those types of plans, defined benefit plans. In the 80s, 90s, 70s, 80s, 90s, many of those plans went away and were replaced by defined contribution plans because as inflation kicked in and the cost of living increased, the benefits that they were paying out under defined benefits were not very, didn't amount to a lot. If you drew something every year for 40 years even, you were still getting a minor amount compared to what current living costs were. And it also got very expensive for the companies to maintain those types of defined benefit plans. So a lot of them converted over to defined contribution plans. As a general rule, the things you will see as one of these plans is either a 401k or a 403b. Generally, a 403b plan would be established by a governmental entity or a school or even a church could establish a 403b plan. 401k plans are very popular among corporate America in providing for their employees to have retirement income. Self-employed individuals, and the minister, remember, is an employee for income tax purposes, but exempt from being withheld on for withholding of income tax, but is self-employed for self-employment tax purposes. So as a minister, you are treated as a self-employed individual. You can establish a variety of individual retirement plans. I've listed three here: an IRA, an individual retirement account. As a general rule, the most you can contribute there is $6,500. A SEP, a simplified employee pension plan, or a solo 401k, where you put in a certain amount, and it can be for an individual less than age 50, $18,000 a year. For an individual over age 50, it can be $24,000 a year. So as a self-employed individual, you can contribute to one of these types of accounts, and the type you select will either have greater or lesser limits depending on what you select. Also may have greater or lesser amounts of fees associated with it. The individual retirement account, as we talked about, a maximum annual contribution of $5,500. If you're over age 50, you can contribute up to $6,500. Depending on other income, contributions to a regular IRA can be tax deductible. Withdrawals from the IRA are taxable as ordinary income. The contributions to the regular IRA can be tax deductible. Like I said, that depends on the amount of adjusted gross income you have. If you do get the deduction, that's fine. If not, you get tax bases in the retirement account that you get to exclude as you take the withdrawal. So, for example, if you over many years had contributed and some of your deductions were, or some of your contributions were deductible and some were not, and so you had accumulated a pot of $200,000 and $20,000 of it were non-deductible contributions, then you could take 1/10, 20 out of the 200, 1/10 of all your withdrawals would be return of principal, your contribution, and the other 90% would be taxable income to you. So if you are doing this and your contributions are not deductible, you need to keep track of that. Form 8606 is how you keep track of that in filing your income tax return every year. So you will know how much basis you got in that retirement account. A simplified employee pension I talked about earlier, a maximum annual contribution of 25% of net earnings from self-employment up to $54,000 annually. That was the 2017 limitation. I don't believe it went up for 2018. And any withdrawals from the SEP are taxable as ordinary income. We talked briefly about a 401k earlier. You can set up a solo 401k where a self-employed individual can put the maximum annual contribution of $18,000 up to $24,000 a year if you're over age 50, plus 25% of net earnings from self-employment to total no more than $54,000. So the limitations here seem to be fairly similar between the SEP and the solo 401k. The difference being that you are deferring part of the income from salary in the solo 401k, whereas in the SEP, you're not doing that. The SEP is being fully funded out of the net earnings from self-employment. And once again, on the solo 401k, the withdrawals from that account would be taxable as ordinary income at the time you take the money out. For all of these plans, you have to start taking out when you reach age 70 and a half. You can take out earlier. If you take out earlier than age 59 and a half, then there are potentially penalties for taking out early. If you take out after age 59 and a half, then there generally are no penalties for taking out early. The reason I'm stressing some of these things, as we mentioned in the discussion around exempting out of Social Security and Medicare, if you choose to do that, you have to make provisions for your own retirement. If you are going to exempt out, and I understand the 15.3% of income is an expensive thing to face every year, and if you're going to choose to exempt out because you don't want to fund that, you have to fund something such that you have retirement income when you are retirement age eligible. I don't have any more discussion. We are going to, I'm going to end the class at this time, save the video, send it out. If you do have questions, since no one was online to participate, I will address any questions you may have if you want to send them to me via email. Just remember there's a couple of distinctions there. A church plan, which is established under state law and not subject to ERISA or an ERISA plan. And if you have an ERISA plan, it's generally going to be either a defined contribution plan or a defined benefit plan. Defined benefit plans in today's environment are generally only found in small companies that make a lot of money and want to sock away a lot of money for the owner. They can do that because they can define what kind of benefit the owner is going to get when he retires and fund whatever is required to finance that benefit at the time he requires. Still a legitimate deduction, still able to be done. It's just that most of corporate America has moved away from that and moved into defined contribution plans so they can limit how much they have to put into the plan. So I will emphasize once again that if you choose to elect out of Social Security coverage by filing the Form 4361 and not being covered by Social Security, it is imperative that you, as a responsible individual, make some other arrangement for your retirement. My personal opinion, go ahead and pay the Social Security self-employment contributions because by the time you get old enough, I don't think you could save enough and put aside enough to match what Social Security is going to pay you in your retirement years. Personal opinion, you don't have to follow it, just my personal opinion. The other thing to think about in some of these, a lot of times employees would put money aside into a retirement account with the anticipation being that tax rates would be less when they retired because they would have less income. With the current tax rates, that may not be the greatest of strategies. I mean, the tax rates that we're seeing right now under the new tax law, initial rates of 10% on individuals moving up to 12% and a 22% rates. Those rates are very low compared to historical rates in the U.S. And if Congress changes dramatically and the presidency changes dramatically over the next few years, those rates that we're seeing right now may not last. So you may put money aside and get deductions that save you 10 or 12% and then pay tax on that money later when you draw it out at a higher tax rate. So that's just something else to keep in mind as you make plans. I wouldn't do it just for the tax deduction. Which we saw some people doing earlier when they were in a 39.6% tax bracket. Yeah, it may make sense to put some of that money aside and get a tax deduction and then come back later in a lower tax bracket and not have to pay as much tax on that income. So, like I said, if there are questions or comments or issues that you would like to see expanded on, send those to me via email. And we will go ahead and do that. Let me stop the share here and go ahead and stop the recording. And we'll get that video posted out to YouTube later this evening. Thank you.